We live in a world where physical stability can ignite in an instant. A single environmental crisis can dismantle global supply chains in days. Political structures that took decades to stabilize can fracture in a single afternoon as social unrest reaches a boiling point. And when a geographical choke point freezes, the resulting shockwaves hit the global economy with immediate, measurable force. Our usual tools for anticipating these shocks, traditional polling and political punditry, frequently fail to see them coming. The problem is that experts rarely face consequences for being wrong. Without a financial penalty for inaccuracy, there is little incentive to provide a precise forecast. This line shows an alternative. Prediction markets have seen their trading volume spike to $21 billion a month. Major media outlets and financial analysts are now integrating data from these platforms as a primary source, often favoring it over traditional public opinion polls. This shift has turned prediction markets into a mature financial infrastructure, one that treats global uncertainty as a tradable asset. To see how this works, look at an impending Federal Reserve decision on interest rates. The outcome will move trillions of dollars. In a prediction market, this event becomes a binary contract. If the rate cut happens, the yes contract pays exactly $1. If not, 0. Because the payout is fixed, price becomes a probability indicator. Trading at 65 cents signals a 65% chance. This relies on aggregating thousands of independent opinions. When diverse groups provide their own data points, the resulting average is consistently more accurate than any single expert. Financial risk forces honesty. Because participants have their own capital on the line, vague opinions are replaced by researched, calculated positions. The volume explosion we saw in 2026 was driven by two specific technological shifts: blockchain infrastructure and autonomous AI agents. Cryptocurrency rails allow for continuous 24-hour liquidity and lower transaction fees than any traditional bank can offer. Data reveals a strange trend. 14 of the 20 most profitable wallets are autonomous AI bots. They ingest news and economic reports instantly for latency arbitrage. While a human reads a headline, these bots analyze probability shifts and execute trades in milliseconds. Prediction markets no longer just aggregate human belief. They now harness the analytical processing speed of machine intelligence. The mechanics of this system are highly efficient, but their application has triggered a significant regulatory crisis for governments. Regulators are currently deadlocked. They are struggling to decide if these platforms should be governed as financial derivatives or banned as illegal online gambling. There are also ethical questions about the nature of these bets. The proposed Death Bets Act was introduced specifically to block contracts tied to wars, assassinations, and other human tragedies. Insider trading is a growing concern. If someone has non-public information about a real-world outcome, they can manipulate the market price for a guaranteed profit. Humanity has developed a technical mechanism to quantify global uncertainty with high precision. Now we are finding that existing legal and ethical frameworks have no clear answer for who manages this tool or how its data should be applied.